We are going to be talking about S Corp shareholder basis, what it is and why it's important in the tax prep process. And I know there are a lot of you that actually don't prepare tax returns at F&R, so how does it apply to you? So for the advertising marketing team, I think it's important because as you're doing, posts or newsletters, there are a lot of S Corp rules that we can actually send to the clients in part of our advertising marketing campaign. So it's just kind of good to get, a basic feel, because the majority of the businesses that we do the tax returns for are either partnership or S Corp. It's also important because, Kelly, when we do request copies of the tax return, a lot of the times we don't have a basis schedule. So if you need me or Marisol to show you what the basis schedule looks like on a full 1120S return, and then that way you can go through it and see if we're missing it, to go ahead and request it, because it's really important to the tax team to have something to jump off of, because if not, then we would have to spend the time to actually build it. We would have to build the basis from scratch. So that's where it kind of is important for your team, and then obviously the tax team. All right, what is shareholder basis? It's a measure of the amount that a shareholder has invested in an S Corp. So just to give you some background, if your client is a C Corp, it's taxed at the entity level first. If the C corporation opts to distribute the income among the shareholders will then have to pay taxes on the income received as dividends. And then I bolded it here. The income is taxed twice, once at the corporate level and once at the personal level. The S corporation, on the other hand, only has one level of taxation. Therefore, when an S corp produces income, the corporation doesn't need to pay taxes on this income at the federal, corporate, or entity level. Instead, the income is allocated among the shareholders, and the shareholders are responsible for reporting the income on their individual returns and paying taxes on this income. So what does all this mean? When you have a client, let's just say they're currently Schedule C, and they're paying a lot in self-employment tax. We'll do tax planning for the client. There are two options if you're going to go ahead and have your client incorporate. There's the C Corp and then the S Corp. The C corporation, how it works is the shareholder will give him or herself reasonable compensation with a W-2. Maybe the leftover net profit is, let's say, $50,000. If they take it out, that net profit out of the company, they have to take it as a dividend, and then they're taxed on it. But the net profit is still also taxed at the entity level at the C Corp tax rate. So that's why it says they're taxed twice. A lot of times when we do the tax planning, the program will actually say that your client should, the best benefit tax-wise will be the S Corp. And the reason it says one level of taxation is because the S Corp, like a partnership, is what's called a pass-through entity, meaning this doesn't pay any tax on the federal level. What happens is if you have that same $50,000 net profit after reasonable compensation, it flows to the shareholders, and depending on the ownership, if there's two people in it, 50-50, then 50% of the income goes to that shareholder and then 50 to the other. What is shareholder basis? Besides income, any loss, deductions, credits also flow to the S Corp shareholders, again, because it's a pass-through entity. So not just the income, but losses on the return, any deductions, or any tax credits. The shareholders cannot assume that the corporation's losses passed through are automatically deductible on their personal income tax returns. And the reason that I put this here, and which is really important, is because a long time ago when I was first starting to do tax prep, a lot of CPAs, they weren't tracking the basis. And what they would do is, if there was a loss on the return, so let's just say somebody lost $100,000, then on the K-1, one officer shareholder, there's a $100,000 loss in the K-1. They put it on their personal return. Oh, you lost $100,000? Here, $100,000 loss from your S Corp. You can net it against the rest of your ordinary income, and then obviously their tax bill is going to go down. I think everybody selectively forgot that the IRS actually made rules that said, okay, well, you can take the loss, but only if you have basis. So whenever we're preparing a tax return, and I'm really a stickler on this, Faye knows, right? If I don't see a completed basis schedule on that tax return, it's going to be kicked back to you.
And it better match the K.
And it better, it better reconcile,
Yeah.
because of the fact that this is super important. And I bolded it here. Whether a shareholder possesses enough basis will determine whether he or she conduct the loss on their individual tax return. If you've put in $100,000 of your own money into your S corp and you didn't do too well and you lost your whole $100,000 on your K1, that $100,000 definitely can be deductible on your tax return. But what happened before is that maybe somebody put in $1,000 into the company. Well, you've only got $1,000 skin in the game. You can't write off $100,000. You can write off $1,000, and then the other 99 is carried forward. So I wrote here, this was discovered through IRS audit, because back in the day, it wasn't mandatory for tax preparers to actually include any basis information. So the IRS was giving all the preparers the benefit of the doubt that they know the rules, that they are actually implementing them as they prepare tax returns. But then as they were auditing S corps, and they said, okay, well, show us your basis schedule, there is none. And then when the auditor actually built out the basis schedule, realized, you guys don't have basis. And then they go ahead and open up their personal returns, reassess the tax, and that's when it gets ugly. So the IRS decided, you know what? We're assuming that everybody does it wrong. So literally effective just last year, S corporation shareholder basis is now reported officially on a 7203. So there's no way now that any tax preparer doing an S corp return can hide the basis anymore, because you are literally now having to tell the IRS whether they have basis. So it's super, super important, because if we get the basis wrong, it's not an internal thing that you can fix, because you're going to have to report it on their personal return. And if there's a mistake, then you're looking literally at amendment. So this is why I'm presenting today, because we have so many S corp clients, and they're mostly single owner officer shareholders, and we're here to save them taxes, not create more taxes for them. Okay, what is the purpose of stock basis? And the reason that I have stock underlined is because with an S corp, there's actually two kinds of basis. You can have stock basis and you can have debt basis. But for the sake of time and training, and I'm sure everyone's still waking up, I'm only covering stock basis, because there's two ways actually for a shareholder to give themselves basis in the company, but 99.9% of the time, it's through stock, not debt. So the main purpose is to help determine whether the distributions are taxable and whether losses can be deducted. And here's an important nugget here. Stock basis is calculated once per year as of the last day of the S Corp's year, and is tracked from the first day. So I have seen S Corp returns from clients that have had their returns prepared somewhere else. This S Corp went back to 2007, and there was no basis. So you'll see situations like that where, you know, it's almost impossible to rebuild the basis schedule. So for the tax preparers here in the room, we just have to do our due diligence and take at least the last couple tax years. You know, if they give, we usually request 3 years. So at least go back those 3 years and manually build it out. I mean, that's the best we can do. We can't go back to 2007. I don't think anybody has the documents anymore. So we try to do that. For me, that's what I also do, is when they don't provide us the shareholder basis, Kelly, you know, we ask first, do you have it? Can you get it from your former CPA? And if the answer is absolutely no, then yeah, unfortunately, as tax preparers, we have to take the time to build it out as best we can with the information we have. Reasons to calculate basis. If a shareholder takes a distribution and he does not have any basis to cover the distribution, and notice I left in brackets, we're assuming that the shareholder officer is compliant with reasonable compensation. Reasonable compensation is a whole other presentation. So again, I don't have any time, but just really quick, whether you're a C Corp or whether you're an S Corp, if you're the officer shareholder, you've got to give yourself a salary. I don't care if it's $100. There was one time with a client, I'm like, you took $20,000 distribution. You're going to have to take this as taxable capital gain because you don't have any basis. You don't have any reasonable compensation. We need to do something. Because if not, then yes, whatever they took out becomes taxable gain, taxable capital gain to them. Then it says here, if the shareholder possesses a loss and does not have enough basis, some of them say, well, did I just lose it? No, you didn't lose it. It is literally suspended and carried forward. So instead of deducting it this tax year that you're working on, if they don't have basis, they don't lose anything. It gets shifted to the next tax year. And then when the shareholder gets rid of his or her stock in the S Corp, the loss or gain on the disposition is calculated using the stock basis. So we do have at least one client that closed her business last year. So we need to know this. We need to know the stock basis so that we can calculate that. So we'll go by steps. Step one, we'll start with their initial capital contribution or the initial cost of the stock they purchased. Note, you'll come across many tax returns prepared by other firms. Not to throw other firms under the bus, but like 100 out of 100 is wrong. I've seen. It's painful. But anyway, they don't have any stock on the balance sheet. You'll need to let your client know there's a compliance error. And then in the tax year you're actually preparing, there's no excuse. You need to put stock on. So at least for us, we're going to show the client, the new client, we're compliant. We're now making you compliant. So put that stock on there. So let's do an example. We're going to say 1,000 shares were issued at $1 par value. So then you'd book $1,000 of capital stock on the books in the tax return. So right now on everybody's piece of paper, our initial basis will be how much? $1,000. All right. Okay, step two. The shareholder's initial amount is then increased or decreased based on pass-through amounts from the S corporation. So income makes your stock basis go up. Loss, deduction, or distribution makes your stock basis go down. But what does this say right here? Can anybody read this one?
A shareholder's stock basis cannot be decreased below zero.
Cannot be decreased below zero.
Yep. Every day.
Okay. The tax softwares know this, but the tax preparers don't know this. So I have seen the case where you've got negative basis, and then the officer shareholder decides, I'm going to take $5,000 out of the company. The tax software will not let you take the $5,000. So you're still going to see the negative basis, and then now you don't balance your tax return. Yes, Marisol.
Question, what about contributions? Because clients will constantly, they'll treat it like a Schedule C, and they're like, oh, I'm putting money in because I need to cover for X, Y, and Z. And maybe they'll leave it in, but maybe they'll take it out. Is that not included in this calculation?
Contributions will increase basis.
As well?
Yes.
Okay.
Capital contributions?
Yes. Mm-hmm.
Capital or assets?
There's a whole line on this.
Yeah, and so again, tax preparers may or may not remember this fact, but the tax software does. So what ends up happening is there's still $5,000 of distribution that actually did happen. What do you do with it, right? Because you can't go below zero. So then you have to now, as the tax preparer, think about, okay, well, now what do I do? Because they took the money out without any basis. So you'll either pick it up as taxable gain, because that's what ends up happening if you have a distribution with insufficient basis. Or, which is the one that I don't like to do, but is the majority of the time we do, is reclassify the distribution as shareholder loan.
Yes.
And what does shareholder loan entail? All the loan documents. You have to actually, there has to be real interest. So you have to go on the IRS's website and you have to calculate that minimum federal rate. And you have to do all the paperwork. So, I try to avoid that. So especially if we're doing their books, we really have to be proactive and we have to watch the distributions and the contributions, because we don't, especially for the accounts that we handle, we don't want to get in that kind of situation. Step 3, there's an ordering rule. For computing the stock basis, increase for income, decrease for distributions, decrease for non-deductible, non-capital expense, and then decrease for items of loss and deduction. Here's Johnny. He's the sole shareholder of XYZ and S Corporation. He originally contributed $15,000. So this is his initial contribution, $15,000 to his S Corp. He received a K-1 with the following items reported. Bummer, has a loss that first year. Earned $100 of interest income, maybe because he invested in Alex's products and made that. $500 of charitable contributions, $50 of non-deductible, and then $12,000 of distribution. And then again, my assumption here is there's no debt basis. So we're just strictly going by stock basis and this activity on his return. So we're going to do that ordering rule. So stock basis is first increased by items of income. So how much did he originally input into his?
50.
Then he made 100, right? So now our stock basis is at 15,100. Then we're going to go ahead and reduce by distribution. So thankfully, right, he has basis. So we're still a positive. So we're positive 3,100. Johnny has adequate stock basis to be able to take the distribution. Therefore, the entire $12,000 distribution is non-taxable. Next, the stock basis is reduced by non-deductible expenses. And we saw that. There's $50 of something. So now his stock basis drops down to $30.50. Then lastly, stock basis is reduced by any loss or deduction. If he had an ordinary loss of $2,000, charitable contributions of $500, his stock basis drops down to $550. And if he did not have enough basis to take the $2,000 loss, right, if we are already in the negative here as we're doing the calculation, the loss is suspended and shall be treated as incurred by the corporation in the succeeding taxable year with respect to that shareholder. So, you know, they're always worried about, well, when do I get to take the loss? And we just have to remind them, you don't lose it. You never lose it. The IRS just says you can't take it in this tax year. We're going to track it with the basis, right, the 7203, and then it's just suspended. And then in the following tax year, if you have a good year, right, and you made $2,000, you can go ahead and take the loss. So 2,000 minus 2,000. So in essence, you don't have to pay tax on anything the following tax year. And sometimes, too, we'll get into the situation where you've talked to the client and said, listen, you took all this money out. I don't see any compensation. You're going to have to give yourself a late W-2. You're going to have to pay the payroll taxes and have to pay all of the late payment, filing fees. Because our goal is to teach our clients the importance of doing it right and the compliance, because a lot of firms, they don't care. You give me your money, you give me your data, I stick it in the tax program, I walk away. But that's not how F&R is. And that's why we have advisory in our name, right? Because we have to advise the clients. We have to be able to walk them through what's happening with their tax return and telling them these issues and being very proactive of avoiding it in the future. Because the whole goal of having clients move from somebody else to our firm, because I believe we're the elite, right? Because I've seen the crap, okay? Like the way we do things is up here, and most of them are down here because it isn't about the people, it's about the money. So all of this, they could care less. They're now forced to by the IRS, but from everything I've seen, they're usually wrong. So our goal too is here at F&R is to be able to get new clients compliant, and also to be able to give them and walk through to them the whole return, and for them to understand what's really happening, because a lot of people have been converted to S-Corps by prior CPAs. They don't even know how the S-Corp works, because they're asking the wrong questions, right? And the more we know about all of this, the better we can serve the clients. And so I actually took a snapshot of what the shareholder basis looks like in Drake. So that, and then I gave the numbers. So then this whole calculation here gets the same number as what I put in the slides, so that you can understand and maybe, walk through if you want to look at the slides later. The last one? Okay. So now I'm open for any questions from anybody about the S-Corp.
I'm still, maybe I'm just not getting it, but like when I asked earlier when they contribute money in.
Right here. Line 2.
Additional capital contributions.
Yeah.
Okay, good.
So just remind your client that if you're going to go ahead and contribute capital, it will give you basis. I mean, there's also the debt too, where maybe right here, instead of doing it that way as a capital contribution, they will do debt. But 99.9% of the time, they contribute money, they take their distribution, and we kind of avoid the whole debt basis, because that's still a loan. And you still have to do loan docs, you have to calculate interest. It doesn't go anywhere. So just because it's here instead of here, and you get the same net effect, this still involves a loan. It has to be a real loan.
So is debt basis only if it's a loan to the shareholder, or does that include other people?
This is just the shareholder loaning money to the company. So everybody else sits on the balance sheet as a loan payable, but this is where it actually affects basis. But people don't realize when they're playing with a basis schedule, and you put something in the loan to shareholder, it doesn't magically go away. And so I was talking to one of the clients, and I said, you've got $67,000 on your balance sheet of loan to shareholder. Do you even know how you got there? No. The prior CPA, I don't know, maybe they did it to plug it in. I said, well, you're going to have to do loan docs. I said, because if you get audited, you need to prove something, because you just can't randomly say, okay, I'm just going to make it balance, and not tell the client what that really means. We have to tell them, you're telling the IRS that this is a loan, that the company loaned you $67,000. And by the way, you have to pay it back. So I don't know if Faye wants to share what happened with Cell Medical.
Oh, yeah.
You want to just share that
Sure,
with
sure.
the loans?
We had a client, and of course we're doing 3 years of tax return, and they're closing the company, okay? Well, this guy, he opened this company just for one client, to keep this one client, but he did make money, and so he had to throw money into this company from his other entities, because this one client did not sustain what was going in and out, and he had these other 4 companies that was like buying the equipment for this one and then giving it to this one, and then he had people that he was paying like a commission to sell the medical equipment, et cetera, et cetera. So basically what ended up happening is, their bookkeeper, and she's very knowledgeable, but doesn't know enough about this to know that the man needed to take a salary. And he was just, running all this stuff in and out and thought it was okay. And we were like, you can't do this. I mean, we were going to have to set up a loan, because even though it's out of his pocket and he's got the, 5 entities here, and just, taking the money out of his pocket and giving it and spreading it around, you still got to have the shareholder loan and the interest and everything to show it. Well, we went and we have a spreadsheet that she's created that we did all the ins and outs and automatically calculated the interest, and then they were like, well, the net result was like $30,000, but the sad thing is we had to show the whole like $160,000 that he actually went in and out. And so now, if the bottom line is, if the man wanted to pay the $130,000 worth of taxes, we could close the company down as of December 31st, 2022. But we sat and did like 10 different scenarios. I worked on it, then me and Marlene worked on it together, and she goes, now I know why you struggled so much with this for a week. But basically, bottom line is we came up with a creative accounting situation that actually going to save this client $130,000 in taxes. We're rolling it because they kept the bank account open with like $27. He's going to loan the company the money of his shareholder loan, write a check, deposit that into the account. Then he's going to write a distribution check to himself back for it, zeroing out the bank account, and therefore we do not have to really show, we're showing the interest on the shareholder loan, but we don't have to show the
Tax them on the
shareholder loan
principal.
final. Right.
Yeah.
So therefore, that eliminates that tax burden off this client, and they finally agreed to it. We went back and forth for like a week on that. He didn't understand it, but we finally, got him to understand, we're trying to save you this money, you really don't wanna have to pay this. And so he finally agreed, cause he was like so bent on closing this company out in 2022, but since the bank account was open, we legally can, close it out at the end of July, which is what we're doing now. So, that's a whole nother way that F&R helps clients save money in the middle of a bad situation.
Yeah. And that's why I'm doing the presentation, because doing this for the client is proof of who we are, what we do for people, that we care, because a lot of firms don't do this. They could have easily just taken the tax prep money from Cell Medical and said, you know what, you want to close it down? Sure, let's just zero out the balance sheet. Nobody knows anything. Here's the thing, and this speaks to me powerfully about our core values, integrity. Nobody sees what you're doing, so nobody knows. The IRS doesn't know, right? You can just zero out the balance sheet, tell the client you're done with your tax return, here, just sign it, we'll just e-file it, we're all done. But there's something wrong in the background. And because we have integrity, we can't just zero everything out, sign our name, and just be done with it like everybody else.
Well, can we? I don't even think we can, which is why we go through all of that, because the IRS does know, because in the event of an audit, they're gonna say this was wrong. Right?
Exactly. So in the front end, nobody knows, right? And okay, let's just say it never got audited. No one's ever gonna see it, but you know it.
Right.
And what makes us different is because we can't do that. We can't just sign off on something, make stuff go away, right? Just, zero it out, Marlene, what's the big deal? But we have the conscience to say, but it's wrong. And hey, if the client wants it to be wrong, get that in writing that you want it wrong. And then let them know, if you get audited, we told you. We did our due diligence, and if you don't want to take the advice, well, then that's on you. But at least, yeah, I know, we say that all the time. It's if you don't like the scenario that I just painted, that's fine. I can't force anybody. It's like paying taxes. I can't make you pay your tax. If you don't want to pay your tax, don't pay it. But at least for us, I really believe that we are the elite level, because, and Mia knows, I do these investigations all the time. I see the work of other firms. It's appalling. I feel so sorry for all the small businesses, because nobody's in their corner. Nobody cares. Nobody explains anything to them. They don't know anything. I really believe we're one of the few firms that actually do. I think that we're going to blow up to our vision, because we don't have any competition. I'm going to keep it real, right? And if as anal as I am, if I can duplicate it with other people, and we have that team, oh my gosh.
Yeah.
Because I'm telling you, every single tax return that I have reviewed in the last 2.5 years sucks so bad that I sometimes I scream and go, your license needs to be taken away. You need to be in jail. The IRS needs to jail you. And the fact that we're not like that, and that our standard is so much higher, I truly believe that we're going to have those clients keep on coming in, because they can see the difference, and that's why I'm trying to teach everybody this, because it's just so important, and it reinforces just our core values and who we are, and that we care. So I hope you guys got something from it.